So you're competing with 20 people for that property, but how many funds have already raised the money? Very, very few, right? So we raise our hand. We've already got the money raised. It's already a done deal. Nobody else has to say yes. Guess what? We have a massive advantage over all the syndicators.
Everybody, welcome back to the channel. We've got a great topic today. We're going to talk about how to vet a real estate investment firm. And I think it's perfect timing that I'm starting to see a lot of new investment firms pop up. And I've got a great guest, Kenneth Gee. He's the founder and managing partner of KRI Partners and the KRI group of companies. Ken, thank you for coming on today.
Thanks so much for having me.
Yeah, I'm excited to do this. I think the timing is perfect for this because, like I said, I'm starting to see a lot of new smaller investment firms pop up, and I think we really need to understand how to vet those firms. So,
I couldn't agree with you more. This is a topic that I'm really passionate about because you're right. There are so many different options out there, and I watch people every day try to figure out where should I invest, where should I go, what should I think about. It's just it's hard. It's almost like the Wild West.
Yeah, it really is. And I think we need to start with let's tell everybody about your background. I think it's very key.
Yeah, sure. So grew up in Toledo, Ohio, went to Cleveland then, where I spent 5 years as a commercial lender. Then after that, I went and got my master's degree at a small private school called Case Western Reserve University. There I became a CPA. I studied, got my master's in accountancy, went to work for Deloitte for 7 years. And it was there that I got into real estate. But during that 7-year period at Deloitte, I got tons of M&A experience, a lot of due diligence. And that particular office that I was at in Cleveland happened to have a massive real estate practice. So I got real estate from every possible direction you could get it from. And that was kind of my foray then into multifamily.
All right. Well, let's dive right into this because it's, I like to kind of keep things going because I really want to grill down on this. I got a bunch of questions to ask you. I want to start with what criteria do you use to evaluate the credibility and track record of a firm?
Yeah. So what I've come up with 4 rules that I want people to follow when they're vetting firms. And they're not perfect, but they really go a long ways. Number one, you got to look at a firm with experience for obvious reasons. But the most important reason you need experience is we don't know what's coming next, right? We didn't expect a pandemic. We didn't expect, really high inflation. We didn't expect tightening credit markets. So you got to have that experience with that senior management team because you just don't know what's coming next. And you need somebody that has some experience, number one. Number two, they got to have a good track record. That's really, really important. We've got a 25-year track record. We actually paid, I don't know if you know this, we paid a company called Verivest to vet our entire track record. Trust me, it was painful for 25 years of tax returns and everything else. But what they did is they looked under the hood and they, everybody wants to promote their track record if they have one. But it was even more important to me that somebody look under the hood to make sure that I wasn't inflating or, leaving things out, things like that. So number 2 rule is track record. Number 3, I want people to make sure that whatever happens that they as the investors put first. Now that's a little harder to figure out because you really got to kind of look at the fund terms or the investment terms, and you got to basically ask yourself a question. Is it possible for that sponsor to do really well and you not? If the answer to that question is yes, then you probably should really second guess yourself on whether or not you should invest with them. And the last rule, the 4th rule, is really transparency, right? I talk about this, hiring Verivest to come in and vet our track record. That's transparency. Plus, once you're in the deal, you want your sponsor to be transparent with you. We send out quarterly reports, P&L, balance sheet, rent roll, and then we do a whole narrative about what's going on at the property. What's happening with this renovation project and that renovation project and what's happening with delinquencies. See, very, very transparent. I think that's really, really important. We also do monthly webinars online that kind of tell people, I call it the real deal webinar, but it's really what's going on the ground. What are we experiencing? Because I think that people want to know that. So right out of the gate, I come up with those 4 rules because every time I see something bad happen, I judge what happened against those 4 rules. And I usually find at least one of those rules was kind of like a red flag. Hey, I mean, the guy or gal's never done it before, or whatever it is. Whatever rule was broken, it sort of is at least a litmus test to say, okay, should I dive further into this sponsor or not? But one of the things that I think is important, and I see a lot of people do this, they've got a great track record in one type of deal,
Yeah.
But the one they're raising money for now is completely different.
Yeah.
Maybe they're looking at office, they're used to multifamily, or maybe they're looking at, they're used to value add, but now they're doing a long-term buy and hold, whatever it is. You want to make sure that, this is a rinse and repeat for them, right?
Yeah.
For the sponsor, they've been there, done that. They know what they're doing. And I think that's super important.
Yeah, I agree. Now, what specific due diligence steps do you do to take when you're vetting these people?
Yeah, so we don't invest in too many
Okay.
outside investment firms. For us, it's mostly about reputation. It's about word of mouth. It's about talking to people who have invested with them. That's a little bigger. Sometimes it's a bigger challenge. And the reason that is, our investors, we have about 250 investors in various deals, but they don't want me giving out their phone number. They don't appreciate that. They're private people. They don't want to spend their time on the phone talking to other people. So it is harder to do, but that's the number one thing that I try to do, other than follow my own rules for vetting investment firms.
Right.
I want to try to figure out what's the word on the street about these guys or gals, and how do they do what they do. It is with the internet now and all these private meetups and chat rooms and all that stuff, it really isn't that hard to find somebody who's invested with a particular sponsor, because that's the key, right? How does that investor feel once they've invested with that sponsor? Because it's like anything, right? Once you're sold the bill of goods, well, now what do they do with you after that, right? You want to be treated well after that. And that's, I think, the key. And then, of course, I look at their track record. I do all the things that I'm telling you that I want people to do when they look at us to invest with us.
Well, I'm sure people call you up and say, hey, Ken, walk us through your strategy. What's your strategy? Tell us about it. And your investment horizons, your exit strategy. I'm sure they're doing all of that.
Here's what I think is important when you're trying to decide to invest with someone. You got to get in their head, the decision maker's head, and understand how they make decisions. I'm a CPA lender by background. I've seen a lot. I remember I've been doing this for 25 years, so I lived through 08, 09. And one of the things that I found, trust me, that was tough, and we didn't lose a dime.
That's a great education.
It's absolutely an unbelievable education. So what I've done over the 25 years that we've been in business is, when I find something wrong, I fix it. I figure out what could I do to fix it systemically, and then I put a review process in place, right? So every time something goes wrong, every time I see something out there, I try to put something in place that mitigates that risk. It's part of the reason why we do exactly what we do. We do multifamily for a very specific reason, in growing markets for a very specific reason, in good neighborhoods for a very specific reason, and we love value add deals for a very specific reason, right? It's because when I add all these things together, it's an attempt to mitigate as many risks as I can find. I can't make it perfect. I can't make the risk go to zero, but I want to do everything I can to mitigate those risks. So if I would say, if there's a philosophy there, I like to protect the downside, make sure we do our research that we think the upside is there. And as long as I can protect that downside, we're probably going to be fine. And so if that's probably the closest thing I could come to as a philosophy, and that's a risk mitigation philosophy.
Of course, yeah. Now, when it comes to the management team, what are you looking for in a management team?
When you say management team,
if you're going to invest
on-site property?
When people are actually, if they're calling you, what are they saying? Ken, tell us about your team, your management team, your executives.
Yeah.
What do you tell them? What are they looking for from you?
Yeah. So first of all, we're vertically integrated. So we don't think of us as a private equity firm, right? We have our investment team, and that team has experience. I mean, in our senior management team's been involved in some way, shape, or form in 16,000 units. So we've seen a lot. That's important to me. The other thing that's important to me is the other side of the private equity model is executing on the business plan. That's why we're vertically integrated. So another thing we allow our investors to do, and I don't know, I haven't really surveyed other investment firms, but we encourage our investors, if they want to visit the property, just let us know when. We'll make sure the manager's there. You get a full tour. And I think they really appreciate that. I think that's critical. If it's your money, right? If you're an investor and the investment firm says, no, you really can't visit the property. Like, seriously, really? No, that's not okay with me. It's their money. They should be able to, you sold them an investment that is made out of brick and mortar. They should be able to go touch.
They're part owner. Yeah.
That's
And
right.
if I'm going to invest in a firm, I want that ability. I want to be able to. I mean, I'd be a terrible investor because I'd know that property manager's
You
first
know
name.
too
I'd be
much. Yeah,
walking
yeah.
out there. Hey, Alice, how are you doing? Good to see you again.
Yep.
You know, yeah. But
Yeah,
I
no,
just
there's
think
nothing wrong with
you've
that.
got to protect that. I mean, I look at my stock accounts every day. You know, I've got a guy that handles it, but I still look at them.
Yeah.
And you know, and hopefully he won't watch this. But you know, I come up with things to call him about. Hey, what's going on here? And he'll think, man, he's really watching this account when I'm only kind of glancing at it here and there. But you know, you always want to be on top of it and keep everybody on their toes. And you know, if they think that you're actually watching it, you're going to, it's going to be a lot better for you. So
Absolutely.
now, when you're just, do any of the investors that come into you guys, do they do an analysis on the property themselves before they invest with you?
Sometimes it depends on the investor. Some investors don't want to. They want to just
Right.
trust you, you
Just
know.
complete
I mean,
trust.
yeah, yeah. I mean, so when we started out raising money, we started out like most people do as a syndicator. But we've migrated to the fund model for the blind pool fund model, and it's just like a private equity firm. But we did that. We didn't do that because we wanted total control. We did it because we were trying to find a way to be competitive in a
Right.
hyper competitive market like Florida, right? So you're competing with 20 people for that property, but how many funds have already raised the money? Very, very few, right? So we raise our hand. We've already got the money raised. It's already done deal. Nobody else has to say yes. Guess what? We have a massive advantage over all the syndicators. So that was the real reason that we flipped to that model. But when you do that, if you invest in a blind pool fund, you do lose the ability to say, yes, I approve. You
Yeah.
lose that ability. So, but having said that, you know, we're still extremely transparent. And, you know, a lot of people will start off with us small. So they kind of get to know us, get to feel how are we doing? What do we do? How do we do it? And we give them so much information. We still give them the pro forma, all the reasons that we're buying it, and we share all the same information. And so usually what happens then, our goal is these are hopefully long-term relationships. That's our objective, right? I don't want
Sure.
to,
Yeah.
that doesn't help us. It's so hard to develop those relationships. So that's
Yeah.
what we've done in the past to try to deal with some of that.
Yeah. You build that relate because going out and raising this money isn't easy. You know, if
It's
you've built
not.
a relationship and you can dip your toe back in the pool every time, it's just so much easier.
Mhm.
And but now, how many properties are you guys buying every year?
Yeah, not nearly enough. I mean, the biggest challenge we have right now is finding deals. And
Yeah.
you know, we probably are disciplined to a fault. We're really disciplined about our investment criteria. We're not, you know, we insist on even leverage and probably $250 to $300 a month in upside in rents over a 5-year period. You know, we know that investment criteria is what's necessary. Well, those aren't sitting on every street corner, as you know. And when they do come available, we're not the only people bidding on them. So it
Right.
is a challenge. We just know what works and what doesn't. And we just stay super disciplined. So in the last year, it's been almost a year since we've closed a deal. In the year prior to that, we closed 3 deals. We're on our second fund now. We deployed our first fund. We deployed about 17 million in that fund and did it in a little over a year-ish, something like that. Yeah, something like that. But now it's just been dry, and it's because of the buyer-seller expectation gap that's
Yeah,
going
we're
on. I
seeing
mean, you
that in
know,
LA too. That you
a
know the
500
sellers are
basis
still
point
here,
increase.
you know, and the
Yeah.
buyers are here, and it's that gap is still too. It's tough right now.
Well, it is, and it's all interest rate driven. I mean, it's not that buyers want to be here. It's just they can't go to higher. The cost of capital is too high. So we just have, you know, really kind of a stalemate going on. So most of the stuff that's hitting the market is all that bridge debt that's coming due and some of that kind of stuff. You see a little bit of that. So
Yeah.
we're looking at deals constantly. We just ask our investors, look, you've made a commitment to us. It is far more important to me that I do the deal that I think is right. I could have deployed their capital 10 times by now,
Of
but
course.
I'm just not going to do that.
On
And so
average
that's the
deals. Yeah.
challenge.
Yeah. Do you have an exit strategy? I mean, let's say if I'm an investor, say, you know what, I had something come up, I need my money back. Do you allow them out, or how do you work that?
Yeah, I mean, you know, you really can't just give them the ability to go out into some secondary market and sell it to whoever they want. You can't do that. So what we do, occasionally we'll have some life situation happen to somebody. I mean, we try to buy them back, right? We'll buy them out. I mean, it's our money, it's our deal. We'll be happy to put our own money in our own deal.
Sure.
Oftentimes we'll offer it to the other investors in the fund or in the syndication, whatever it happens to be. Usually they're a little more predatory with the other investors.
Yeah,
are.
50 cents on the dollar. Sure,
Yeah,
I'll
that's
take it. Yeah.
Yeah, so we try to protect our investors. I mean, we can't promise, but usually if we buy somebody out, we buy them out at par or something close to that. I don't try to,
Yeah,
once you
I
get
mean-
them in, you got them over a barrel. We just don't do that.
I'm a firm, that might be the Midwest in you because I'm kind of the same way. I just, it's treat them right. They'll come back, and building these client relationships is very, very difficult. No, it's just
Yes.
don't burn the bridge. Make it worth everybody's time.
Yeah,
Now,
you're right.
what's your how long do you guys hold properties?
We try to we pro forma out 3 to 5 years. We're a
Yeah.
value add firm, so we try not to hold too long, but we give ourselves the ability to hold longer should we need to, just because I'm not going to sell with a gun to my head, right?
Right.
I watched too many people do that in 08, 09. We didn't, but their debt matured at the wrong time. There was no place to refinance it because there just wasn't then. And, they had to hand over the keys. So we try to be very, very careful about that. But we don't tell people 3 years and then we keep you in for 15. We just don't do that. That's not fair. So we're looking for 3 to 5 because we don't want to outlive our improvements. Remember, we're value add. So if you hold too long, now you've got new improvements to make and you have no new capital to make those improvements.
Yeah, exactly. What is you guys just then sell after that time frame and take that capital and reinvest, or do you pay out and move on to the next deal? Pay out to your investors.
Yeah, we typically will turn that deal, pay it out to the investors.
Okay.
Right. I like that. Here's why I like that business plan.
Yeah, I didn't know if you reinvested it back into the fund. Say, we're going to flip this all back into the fund.
No, we don't do that. No.
Okay.
No, so we don't do that. Once we call your capital, we use it, we sell the asset, the capital's coming back to you as the investor.
Okay.
And the reason we do that is, number one, I want you to be able to be back in control of what you do with that money. Number two, if you made money or not.
Right. Yes.
The deal is done. I mean, you can't
Yeah.
argue. Did we make money? Is there smoke and mirrors somewhere? I mean, you can't argue with that. And then you get to decide, do you still like Ken? Do you still like KRI? Are they still doing what you want them to do? Were you happy with it? Now you can decide to reinvest or not. And yeah, there's a little bit of tax friction, but I just know that people really get nervous when it comes down to tying up their money for 10, 15 plus years. They just get nervous because what if they don't like Ken? Now they're stuck.
Yeah. But don't most of them just flip it back into the next fund?
Yeah, if you've done a good job.
Yeah.
Yeah, I mean, our last 3 deals we turned was 22%, 30, and 36% annual return on investment. Most of the time, people are going to say, put me back in, right? If you're doing a good job, right? If
I don't want my money back, you keep it.
That's right. Yeah. It's funny because investors are quirky. They want to invest the money. Then the moment they invested it, okay, when are we selling?
Yeah.
It's very interesting to watch investor behavior.
Yeah, but I think, when and a lot of newer investors don't understand, the exit strategy is something they really need to consider. And, if one person would ask the guy that bought the buildings from us his exit strategy, I'm sure it wouldn't have been, it's probably going to go back to the bank.
No, I'm sure not. Yeah, at least I hope not.
But the simple math was, he's putting $1 million into something he paid a little above market at already in an economy that was, and going in, and we went into the lockdown, this
was an apartment building.
Yeah.
See, our properties,
few apartment buildings.
Our properties just thrived through the pandemic.
Yeah.
And it has to do with, remember I said we do a very specific business plan, right? Good properties, good areas. I insist on a diverse income stream. In other words, I won't buy next to a military base. I won't buy next to Disney. I won't buy in the really tough neighborhoods, because all of those things are recipes for potential problems. And the pandemic was a good example of that. We had a couple of people trying to work the system here and there, but it wasn't, in no way impacted the financial performance of our properties.
Yeah. Yeah. No, this one I don't think would have. He's in a pretty good area. but he wanted to start construction on it, so he evicted everybody, and then then he couldn't get lumber, he couldn't get
Oh,
materials.
oh no.
It
Oh
just
yeah.
fell in on top of itself.
Oh
So
geez.
yeah, it was bad, but
Well, see, there's something wrong with that inherent business plan, and that is you said he evicted everybody so he could renovate.
yeah,
We would never do that.
yeah.
We would
He
never
wanted
do
to
that.
turn it very quickly.
Yeah,
He
see,
was
we
going
would
to get
just
in
never
and
do
out.
that.
I
We
know.
just wouldn't. We would turn them as the units turn, do
Came
your
available.
exteriors, do the interiors as they turn.
Yep.
That's maximize your operating cash flow. It's just we would just never throw
Yeah.
everybody out and do
Yeah,
it.
that's
We
what I was
just
saying. If anybody looked at his business plan, I mean, we didn't hear about it till months after we closed. And I
sure.
drove by and there's almost nobody there. I'm like, what happened? And so I stopped and talked to the manager because, yeah, he got rid of everybody. He's going to go in completely, knew everything going in. I'm like,
It's just
that
not
was
our
tough.
business plan. See, that's a risk mitigation strategy on my part.
Yeah.
I don't even like empty buildings. What happens to empty buildings?
Yeah.
Sometimes
Well, you
really
still got to
bad
pay that
things.
mortgage, less pay cash, of course. But, it was a disaster. And I think people need to understand that before you just you don't want to just be looking at the returns. You want to understand how do they get those returns? And,
Mhm.
what is their investment strategy and their exit? You've got to know all of that and you've got to do a deep dive into it. You just can't I mean, your returns sound incredible, but you've got to know how did you get there? And,
Mhm.
you guys are very transparent, so that helps a lot. Are you guys getting funding right now is kind of hard. How are you guys finding money out there?
Yeah, our problem right now is not finding the money
Yeah.
because we have a good
Finding the assets.
reputation. It is finding the deals.
Yeah.
Yeah, it is finding the deals. It's just really hard. And again, I told you I could have deployed every penny we could possibly raise by now, but I just can't find the deals that make sense.
Yeah.
I mean, we just got outbid. We bid $18 million on a property that's under contract for 21 million. There is no way it is worth 21 million bucks. No way. But some
Somebody
people have
paid it,
different
huh?
objectives. Pardon me?
Somebody paid it, huh? Paid that
Well, they're in
21
the
million.
process of paying it. We'll see what happens. You never
Yeah,
know.
I would think you do a little due diligence. You said something. I know some people that are really wanting to understand. Is why wouldn't you buy next to Disneyland or or someplace like that?
Yeah, it's not about I love Disney. I don't have a problem with Disney. I have a problem with
Yeah.
the
Don't get
single
us any
revenue
haters,
source.
Ken. Jesus.
I don't I have a problem with the single revenue source.
Yes,
Right.
exactly.
So I don't like to be by a military. I love military people. I had no problem with military
Right.
people. But the government, although you would think they would never close this base or they would never deploy everyone from this base overseas, one of those two things happens and your income goes to near zero. I don't like that. Right. You're comfortable with triple net leases. I'm not, because that's a single revenue source. I want to have as many different revenue sources as I can from as many different industries as I can. That's why
diversification.
Yeah, because I think that for me that's a risk mitigation strategy.
Yeah.
Right. So I love Disney, but what's also around Disney? A lot of hospitality.
Yeah, it's all
got
hospitality.
Killed during the pandemic.
Mhm.
All of hospitality, all that stuff got killed.
Yeah.
So properties that were heavily dependent on that, they really struggled. I mean, they really struggled.
And in turn, the employees did. And that, that goes across the board. The retail in those areas can be, you don't want to depend on the one person, one company being there.
Agree 100%. Yep.
Yeah. It can be tough. You got to do your due diligence and you've got to ask the questions. And Ken, thank you very much for coming on today. I think this information helped a lot. If you folks have questions, just put it in the comments down below. Ken will get to them. Ken, if you don't see them, I'm going to ping you and say, hey, you've got some questions down below on the YouTube channel. And Ken, thank you very, very much for coming.
It was my pleasure. Thanks for having me.
You betcha. And for those of you watching, make sure you give us a like. And if you haven't done so, make sure you subscribe.